Good afternoon, good evening. Welcome to our monthly real estate investment syndication webinar. This is Philippe Scholegen, co-founder of Boost Capital Group. Today, we'll cover the anatomy of failure, lessons learned from recent failed multifamily syndications. At the end of this call, we will have a Q&A session, and you should have a little window available, question and answer, and you can type your questions throughout the presentation. We'll get to them at the end. And otherwise, we are also recording the webinar, and we'll make that available in the next couple of days. Our team will make some small adjustments and make that available. A disclaimer: Boost Capital Group does not provide tax or legal advice. The material herein is provided for informational purposes only and should not be construed as investment advice or an offer or solicitation to buy or sell securities. So my partner Jeff and I, we formed Boost Capital Group because we share a common vision and values. Our vision is that we believe that everyone deserves to spend time with their family, living a strong financial present while building a bright financial future. And in order to do that, we offer alternative investment opportunities in real estate. We typically work with busy professionals, business owners, and family providers who don't want to deal with the headaches of direct real estate ownership. Together, we have more than a decade of experience, and we've helped people invest in 2,800 multifamily units while achieving above 2x returns on full cycle deals. So my partner insisted on me showing some of the pictures of my involvement with the multifamily real estate community. On the top row is showing I've been a speaker on some panels at real estate conferences. On the bottom right, it's a picture of the commercial real estate meetup that I host in Atlanta. And finally, the pictures I'm the most proud of at the bottom left, it's new entrepreneurs receiving an award for closing on their first multifamily deal. And two of them on the picture there, they are my mentoring students. And in the middle, at the bottom, it's a shout out from one of them on LinkedIn. So today we'll talk about a specific set of properties that went into foreclosure that you may have heard of or read about in the press. And so what happened is earlier this year in April, Arbor Realty, a lender, they foreclosed on 4 properties representing 3,200 units located in Houston, Texas. And the loans totaled $229 million, and the owner was Apple's Way. Actually, in May, there was an additional foreclosure that was filed for $65 million in loan, tied to another Apple's Way property of 1,000 units, 1,060 actually. So those are the facts that we know, and we'll try to differentiate when we state facts, things that we know versus things that we think happened. So in our case study, so we know that 5 properties, about 4,300 units located in Houston, Texas, they've been acquired between August 2021 and April 2022, and the property owner defaulted on their mortgage payment, resulting in a foreclosure. And you can see a map of Houston there with the locations of these properties. Also, what we know, and everybody knows, that the economy, the environment in the economy is high inflation and high interest rates. So the way we approached this presentation is to go over 5 facets of apartment investing. And for each of them, we'll talk about tools to analyze risks and solutions available to general partners or managers to avoid any trouble while executing their business plan. So these solutions we'll talk about, there are really things that you should look for in any apartment investment opportunity. And I'm going to pass this over to Jeff. Jeff?
All right, thanks, Philippe. Yeah, so these are the 5 topics we're going to go over. And the first one we're going to go over is the importance of due diligence. Next slide. So why is due diligence important? It helps identify the risks associated with the investments and helps develop a mitigation plan. So this is one of the things for any investment, whether it's real estate or just partnerships or anything. Due diligence is one of the most important factors to consider when going into an investment or partnering into an investment. So here are a few items to consider for the real estate market when performing your due diligence. The ones on the right, population growth, median income, and crime, were not part of that image. To the left, however, those are very important factors to consider when performing due diligence, which we'll dive a little bit deeper within the presentation. But population growth is something that's important because when investing in real estate, you want to make sure people are not moving out. You want the population to grow. You want people to move in. You want job growth and things of that nature, along with median income. If you're investing in a certain area, you want the median income to be substantially higher than other MSAs. So that's an important factor to consider when doing your due diligence and identifying a market to invest in. And crime as well. So you want obviously the opposite spectrum of the crime. You want low crime. High crime areas usually mean a lower population growth, people move out, and lower income. That's not necessarily 100% factual because you have certain pockets with high crimes surrounded by higher income, but those are just things to consider when doing your due diligence and assessing a real estate market. Next slide. So here is an outlook on that case study Philip covered at the beginning. Those stars you see on the map are the locations of those assets, those 5 assets that went into foreclosure. And as you can see, Houston right in the middle, and there is a graph at the bottom where it has household income and the crime rates. So taking these factors into consideration when doing your due diligence is important. You do not want to be in a high crime area, and you do not want to be in a low income area. They both actually add up to a negative experience, as you can see. You could just use data points like this to identify a property that you can invest in and just make sure that it fits your investment criteria. There is different sponsors that do invest in areas with Section 8 housing, and that's a different business plan, but usually they have a handle on that process. They have better understanding of their tenants. They have better understanding of benefits from counties and how to work with local government. So it's important to identify these features as well. So just because a property is not in the best neighborhood doesn't mean it's a complete failure. Just consider that when looking into the location a asset or a property is going to be that you invest in. Is there anything else you want to cover on this, Philippe?
Yeah, just more specifically on this case study, I think from a population standpoint, I think it was certainly a good market. Houston, it is a good market, and household income. Obviously, they didn't pick the best neighborhoods. Same thing for crimes. And I think at the end of the day, we have our criteria. We would avoid these areas, and it's relatively easy to find with the tools we highlighted on the right there. The Census Bureau citydata.com and other websites, as well as market reports, give you access to this information.
All right. Thank you. So that was assessing the market. Usually that's preliminary criteria of your due diligence before you even pursue a market in a given area. You know, there's a lot of free data available, a lot of other paid for data that you can get when assessing an area before you even get to the acquisition part of the due diligence. So say, you know, all the checks, everything meets your analysis and fits the criteria for the market: income, low crime rate, growth, population size, all those things. And you identify that that's a good area to invest in, and you identify the property. Then you go into the acquisitions part, you put an LOI, and you go into your acquisitions due diligence, which you're looking at financials, looking at your rent rolls, your T12s, just pretty much the cash flow on that asset, the net operating income. You're looking at vendors, whether you have contracts that you can get out of. Those are things to consider as well. The structure of the physical asset, part of the due diligence process, pre-acquisition. Legal and title, obviously taken care of by title companies, and environmental. Make sure the properties are compliant with zoning laws and hazardous material in certain areas. So these are just some things to consider when doing your due diligence. It's not all encompassing. There's other more in-depth analysis, but these are just some preliminary things to point out. So you performed your preliminary due diligence, you walked the property, you're assessing it, and at the same time, you know, you're underwriting the property. You're pretty much, it's very important. The underwriting process is very important. You know, this is where investor benefits from the vetting process that the underwriting provides, and it helps with making the informed decisions whether to invest in a deal. So things, next slide. So some things to consider is always, well, the biggest thing is the income. Is the income great enough to cover expenses and debt service, the payment of the loan? That's the number one thing, right? That's how all investors, everybody gets paid. That's what makes a deal profitable. You have to have some return. So things to consider in regards to income, when you are assessing the situation with underwriting, for example, you know, you're stress testing the projected financial operations of the deal. You know, so if rents don't grow as much as you expect, you have to stress test. You have to see what type of situations you may come across. So is the property value going to increase when you raise rents? Are your projected future rents something that are achievable? For A-class, higher class assets, there might be concessions, as we stated out there. It might be a really good rental market, but there could be a lot of competition. So if you have to provide a lot of concessions in that market, that means a lower income, lower net operating income. That means losses for the property. So those are part of the stress tests to consider when investing into a deal, that the operator is taking all that into consideration. And then also you're faced with lower class properties, kind of like the case study in those high crime, low income properties. The challenges you face are, outside of crime, is the income. Are the renters going to be able to provide funds for their to pay their rent, or are they going to choose to do something else? Are you going to have high turnover because your tenants can't pay rent? So looking at that and deciding if that's somewhere you want to invest your money is important. So the answer for a lot of this can be summed up in having the proper reserves to cover these forecasted stressors. by raising a little bit of money to carry a property in case there is, non-paying tenants, or you have to offer more concessions in order to get the property filled up with tenants to be able to get those market rents in order to get those market rents. So there's different variables, not one size fits all. So it might be a little bit confusing, but the biggest thing is making sure the investment has the proper reserves set aside for these rainy days. And now in regards to expenses always look at, inflation. Inflation has increased the prices of everything, both material and labor. So if an operator is not identifying in their underwriting, in their analysis, that expenses are going to increase, then that could be a red flag. So consider always that there's got to be a increase in expenses. Now, if expenses do not go up substantially, then there's that buffer. It's a positive for the deal. But if there's no forecasted expense increase, just consider that a red flag. And also, when an operator is looking at a deal, it's important to look at everything seller's providing with a fine-tooth comb, because a seller, as we're stating right here, wants to put their best foot forward, meaning they want to have the highest net operating income. So they could be cutting expenses. They could maybe get rid of their bi-weekly landscaping, for example. On paper, it shows landscaping, but you got to make sure that landscaping wasn't just done monthly, it was done bi-weekly, or any other maintenance. They could have got rid of the maintenance crew. They could have got rid of different things that as a new operator would need to hire, therefore increasing those expenses. And the two next categories, insurance and taxes, can break a deal. Insurance premiums have came up a lot in the recent year, and taxes. So if a new buyer takes on a property, there could be taxes that increase with the new owner, and consider inflation as expected. So yeah, all right. And now in regards to rent growth, rent going up. Yes, rents are still continuing to go up. They have slowed down since February 2022, but the rents are still high because there's still low inventory as far as housing goes, whether it's residential housing or apartments. So everybody needs a place to live, and the housing market is not where it needs to be. So rents are still going up slowly, and they have still increased a little bit, not as much as they used to. Rental vacancy rates are pretty much average at the moment compared from 2017 to 2023 Q1. So that's almost staying in the middle. It's not a huge variance, not too low, not too high. It's just kind of in the middle. Next slide. And when, again, looking at a property to invest in, to be a part of, you want forecasted rent. You want to use tools, available data, which is what we do. So here's a graph by CoStar showing the market rents growth year over year, the expected rent growth based on data. Right here, the blue line, you got the market rents per unit, and then you have the effective rents per unit. So, market rents are always going to be a lot higher than the effective rents, because in order to get bodies inside inside apartments, people are gonna, want to compete and still pay a little bit less than what the market rents are. So that's always something to consider. And then you don't want a property to be at the very top of the market, because usually if it's already at the very top, there's really minimal room to grow, minimal room to increase net operating income. So always take a look at that. We have a Dallas Fort Worth market in this. We're actually looking at working on a deal in the Dallas area, which we would slightly touch on at the end of the webinar. And then we have cap rates. It doesn't, so the formula for cap rate, net operating income divided by the market value. So the cap rates are used for the commercial real estate valuation. And it's the interest rates are not part of the cap rate formula, but they do affect it. So when interest rates were really low, the cap rates were really low. As interest rates have risen, cap rates have expanded some. They are still catching up. Sellers are still trying to sell at lower cap rates. So cap rate is something to look at when a deal is presented to you. You have to take in consideration the purchase cap rate and the exit cap rate. There has to be a spread in between the cap rate you buy it to what the cap rate you sell it at, because it's going to be older property. And if you go to the next slide, it will show you the expansion of certain markets here from Q3 2022 to Q4 2022. Those cap rates have increased in unison with how the interest rates have increased as well. So if a property is purchased at, let's say, a 5% cap rate and is held held for 5 years, there should be at least a 10% or 10 basis points addition per year on that cap rate. So if you bought it at 5, it should be sold or forecasted to sell at 5.5% of a cap rate. I hope that makes sense. And as always, feel free to ask questions on the Q&A portion. All right, next slide.
All right, so this one is for me. So the third topic, the third facet that we want to talk about is about the debt and equity balance. And first we'll start with a simple definition. The debt refers to borrowed money that must be repaid over time and typically with interest. While equity, sometimes called common equity, represents the portion of ownership in the property held by investors. So don't get intimidated by this chart. I'm not going to go through everything. I'll just go over the key concepts here. So the capital stack, right? It's important to understand what is a capital stack because of the risk reward implications depending on the position in the stack. And the simple way to look at this stack is that the participants, they're going to be paid back in order of the position in the stack from the bottom to the top, right? And the lower position in the stack, the lower the returns and the lower the risks, because you'll be paid first, whereas you're higher in the stack, you'll be paid second, third, etc. So, usually the incentive is more rewards, but, again, you'll have more risks. Hopefully that's clear. Don't hesitate to ask a question if it wasn't. Again, I don't want to go through everything right here, but I just want to touch on 3 important elements. Obviously, there will always be common equity, right, which is at the top here, the investors. And most of the time, and for all intent and purposes, all the time, there will be senior debt. So common equity at the top, senior debt at the bottom, always there. Sometimes there might be preferred equity, the second from the top, and mezzanine debt, the third from the top. And if they are present, what's very important is that you need to understand that you're going to be paid after these layers as common equity. So you'll be paid back when there's a distribution or when there is cash flow available to be distributed to the different layers. After paying the senior debt, it will go first to pay mezzanine debt, then preferred equity, then common equity. So I spoke recently with an investor and brought that to his attention. He was asking my opinion on a deal and eventually decided not to invest because preferred equity was too prominent on his particular deal. The third things I wanted to bring to your attention here, and I think obviously it's kind of a general thing, not necessarily tied to the capital stack, is that when you look at the senior debt, your interests can be fixed, or your interest rate rather can be fixed, or it can be variable. So if we look at our case study, most of Apple's Way's loans originated in the second half of 2021, just before the Federal Reserve began its campaign to raise interest rates. At one of the property, the interest rate on the loan rose from 3.4% to around 8%. And at least at two of the properties, they were financed with about 80% of debt, which is quite considerable. So here, the solution and that you can use in order to answer the risks tied to a change in the environment for interest rates is, well, number one, to stress test the interest rates. And what if the interest rates were going to be higher in the future? What's the effect on my debt payment? And the solutions that you can use to avoid these difficulties is to lower the leverage, use a fixed interest rate, or use a interest rate cap to have a ceiling for your interest rate. Those are the three solutions there. Fourth facet, the ineffective asset management. And here, obviously, if you're not taking care of the asset as a general partner, as a manager, things are not going to go right. So, just again, in terms of definition, the general partners in a syndication, they have three key responsibilities: the acquisition, disposition part, capital raising, and asset management. Asset management includes overseeing the property's day-to-day operations, ensuring that it is well maintained, occupancy is optimal, and rents are as high as possible. Monitor the business plan execution, so for instance, the renovations, and overall maximizing the profits. Back to our case study, Apple's Way added 6,000 units in their portfolio in less than a year. You have the curve there. I plotted, from data I was able to find, and you can see from 2021 to 2022, you have 6,000 additional units, up to 8,000 units in the portfolio. So even with the third-party property management company that you're going to use, there's still a lot of work on asset management, investor relations, and you're going to need staffing. And from what we could gather, they had 4 people on the team in Apple's Way. So, which is, at this size of portfolio, you would need many, many more people. So the solutions, to answer these possible issues, you need an infrastructure, full-time employees, and what we've observed, with the groups we've partnered with, usually there's about 2 or 3 full-time person per 1,000 of units managed. And for the larger groups, there would be in-house property management as well as in-house construction company. And the other side of that, as in terms of solution, now your asset manager is going to deploy the reserves that we discussed earlier, when assessing income and expenses and setting aside reserves if there were any issues there. The fifth facet is misaligned partnerships. And, here the idea is really making sure that the different interests are aligned. And actually, that's Jeff's slide, so I'm going to hand it back to Jeff. I'm sorry. I'm on a roll there.
All right. So partnerships, misaligned partnerships, just pretty much understanding that the partnership you are becoming a part of, whether you're an active investor, passive investor, it meets your criteria. This holds true to any deal you invest in, not only multifamily syndications, but just any type of deal, right? So you just want to make sure everything and everybody is aligned and on the same page, and anything that you participate in, you're doing it because it meets your criteria. So like I stated, understanding the time horizon of a specific investment, multifamily in this case, 3 to 5 year time horizon. If an investor is not open to that idea, then it's suggested you not invest in such deals, because if you need that money sooner than the full cycle of the deal, it may create problems with the deal itself. So when committing to a specific type of deal with a required time horizon, make sure that is something that as an investor you are on board with, because it can obviously lead to conflicts and may hinder the deal overall, depending on the size of the capital that you are needing back, for example. And then you have uneven contributions. So there's different type of contributions when it comes to multifamily acquisitions. Capital in a monetary aspect is not the only type of capital that goes into an acquisition. You have human capital, time, expertise. There's a lot of underwriting, assessment, due diligence that takes place before any capital is deployed. So when you have some capital at risk, that's when the capital is deployed. You hire people to do inspections, property management company to walk the doors. There's capital that's put towards that needs to get paid in order for people to do work. So uneven contributions can mean different things, but just know that capital in a monetary way is not the only type of contribution. There's the time aspect and expertise aspect to consider. And this is where effective communication is imperative. Understanding that if someone's contributing their time as far as expertise, asset management, meeting with PMs, walking properties, performing due diligence, understanding that there's that communication of all partners understand that certain people are going to do certain things and certain people are going to provide certain amounts of capital. Ultimately, the transparency is important when dealing with these type of investments, so that there's no misalignment or misunderstanding, and it creates trust among the investors. And again, whether you're a passive investor or an active investor in a deal. And again, back to misalignment of partnerships, inadequate due diligence is a problem. So we touched on some due diligence things to consider as an investor. So there's always going to be somebody doing due diligence, but it's job to double check the due diligence, make sure everything is up to par. Anything that's not identified can create problems later down the road, and that is a team effort, the due diligence. And as an investor, even as a passive investor, you want to ask all these questions about how the due diligence was performed, what was considered. Just ask all the questions so that you are not blindsided by unforeseen problems that may arise later on down the road. Excuse me. Now, so this is investment. You, as an investor, whether passive or active, you have to have investment criteria. So here's an example of an investment criteria that we use. An investor can see what type of deals, size deals, or hold periods you can expect. The sponsorship, what kind of sponsors you want to work with, what kind of experience you expect them to have, the size of the market, and the effects of the market, the crime, low crime, high crime, diverse industries, and then the target returns. That's very important when you're looking at the underwriting, that the target returns meet the criteria. You don't want to put money into a 5-year deal and it's not going to satisfy what you need. So always look at these investment criteria, have your own investment criteria so that you know what your targets are.
Yeah, just one quick note is on misaligned partnerships. One of the answer, as highlighted here, is like you really want to dig into the sponsor, the team, their experience, their reputation, the number of units they're managing, how many deals they had full cycles on. Those are very key to answer and avoid misaligned partnerships. So final thoughts, as we discussed, as we presented back in February in our webinar, then I think we still see that there is a strong demand for housing, for rentals. Part of that is the population growth. The other part is the high interest rates, and it's certainly easier to rent than to buy these days. The real estate single family market has slowed down at some point. I think it's coming back, but it's because of the interest rates. The foreclosures, such as Apple's Ways in Houston, they remain pretty rare, but they could become more common because these rate caps or hedging contracts that protect landlords from rising interest rates, they're going to expire. So, and for information linked to that fact, there's $150 billion in mortgages that are set to expire this year, and another 900, almost $1 trillion set to expire in the next 5 years. So, and that's something actually I talk regularly about with my students. There might be a lot of opportunities coming in the future, but for now, they seem to be really handed off these opportunities to very, very high, larger groups. So eventually it will probably trickle down to all of us, unless again they found solutions, and maybe the market will turn around and there could be a refi and no foreclosure at all.
Yeah.
Yep.
So in conclusion, just use all the tools that are available at your disposal. Essentially, ask a lot of questions, do your due diligence, come up with your own criteria, and make sure you stick to your investment criteria. If a deal or market or location is not for you, then it's recommended you do not participate in that deal. But as stated, use data, ask questions, and do your research.
All right. So just before we go to the Q&A, we wanted to briefly touch on this new deal we've just introduced. It's located in Dallas, Texas. It's 228 units. We're not here to pitch, so I'll just go very, very quickly. 2x equity multiple. It's a fantastic team. If you're interested, let us know. We can have a conversation. We just wanted to make sure that you were aware in case you were interested. And, we're going to carry on to the Q&A. We have a couple of questions in our Q&A box. Again, if you have any questions, please ask them there. I see a hand risen. We will get to that hand after because I'm not exactly sure how that works. So we'll start with the questions. Esteban, what are the guarantees that should be made to LPs? For example, pref cycle length and guarantees that should not be made. That's an interesting question. That's a good question. When you talk to SEC lawyers, they will tell you that you cannot guarantee anything pretty much. So you have to make sure that, when you're presenting targets that or forecast or anything of that nature, it's very clear that those are projections for returns. Those are projections for the hold cycle, and things can go wrong, and the returns can be lower, and the cycle can be longer. That's why throughout the presentation we spoke about you're going to work on a kind of a nominal path. That's your baseline, and then you're going to stress test income variations, expenses variations, occupancy variations, interest rates variations, you name it, to see what the effect will be on the returns. And typically that's something you want to share with the investors. But yeah, the guarantees, death and taxes. That's the guarantees.
Yeah, it's difficult to guarantee a forecasted something that's forecasted with data. It's not a crystal ball. It's just a lot of thorough analysis of understanding the markets and the investments. So guaranteeing specific returns would be a red flag. So if you have guaranteed returns, take a look of how it's guaranteed, but it's highly recommended through SEC lawyers that a lot of returns are not guaranteed. They're just full-blown assessments on past performance. But yeah.
Okay, so next question. Actually, I will say, okay, so this is done. If from Christopher, if you get into a syndication deal and you don't like how ours being run, how do I get out of the deal? Well, you can talk to the managers, to the general partners, and ask them if they can find somebody to buy you out. It's not always possible, and that's something we make very clear to investors up front. We'll try our best to work with them if something happens, but it's not always possible. So I think you have to talk to the general partners and see if they can buy you out, or find somebody who can buy you out. Or I would say alternatively, if you bring somebody to the table who would be willing to buy you out, I guess at the same time, if you don't like how things are being run, I'm not sure if you can find someone, but they may have another investor who would be interested, one of their either other investors on the deal or another investor they worked with in the past that could be interested.
And before you participate in the deal, ask that question: Can I be bought out to get ahead of that? More times than not, because a full term deal participation, but always ask that question. It's important to have that answer.
The next question we have, Paula is asking, how do you review and decide what is correct when reviewing where tenants get their income from? I don't go to that level of detail. I would let the property manager, probably, like, that's something you can ask them what's their criteria and see if that's in line with what is commonly done. There could be some nuances market by market, I assume, though. I think it should be pretty, if they provide like pay stubs, they could be like Section 8 payments. I don't know what specifically you have in mind on this. I know, Jeff, you had first-hand experience with.
Yes. So I assume it's like maybe during due diligence you're reviewing the property. You would get the leases and the applications from the current owner of the property that's selling. So with the company, that you review the leases and those applications to identify where this income is coming from. Usually, those are not updated on a regular basis. People can go from one job to another and not inform the apartment complex that they change jobs. But in order to see that the tenant does have, in fact, income, take a look at the leases and the applications, and that should be able to provide you some more granularity on where their income is coming from. I don't know if that answers the question, but that's one way to look at it when you're doing a due diligence.
So next we have Mandy. Can you talk about why someone would invest with their 401k or IRA? What are the benefits or penalties for doing this? Yeah, why? I think the idea there is, especially for people who have a 401k with a prior employer, then you have flexibility to use that money as you wish, especially if you put that money into a self-directed IRA. And from that standpoint, if you have an IRA in place, but with a large, investment firm, you don't have the option to self-direct your funds, and that's why you may redirect your funds into a self-directed IRA. And in that context, there's a custodian that would be there to make sure that everything is done legally, and using that setup with the self-directed IRA, it will allow you to invest into passive investments in real estate. We're not talking necessarily of taking money out of a 401k with early penalty. That's not what we're talking about. Though some people are considering that on occasions. I would, really, like, you have to think twice and discuss with your CPA if it makes sense. The third option I can think about is on a 401k, you can borrow money, and if the interest rate of borrowing your own money of your 401k and the returns you may obtain on a deal, are going to be higher, there's a spread to be made, and it could be an interesting way to deploy your money. Finally, we do have a link on our channel where we had a discussion last year with a self-directed IRA custodian, and we can look for the link, and I'll post it in the chat in a minute. Anything you wanted to add, Jeff, on that topic?
No.
All
Just
right.
always consult with your CPA and tax professional.
Amir, how do you bridge the price gap between buyers and sellers? Will sellers reduce the price? What's your outlook? Well, we're expecting sellers to reduce the prices for a long time. And I think it's really like the opportunity will come in distressed properties, though we have not seen a lot of those coming up on the market. I've seen a few public auctions on foreclosed properties, but it's very unusual, and it's a kind of a weird. It's not like your typical deals, and you don't have like the typical informations and so on. That's why it's I'm approaching this very cautiously. I think what's going to happen really is that the interest rates are going to reduce, and prices are going to go back up, and then eventually it's going to make sense for acquisitions to occur. But I think more than before right now is a little bit a needle in a haystack type of situation. Even like our partners on that Dallas deal, I think they mentioned they looked at 200 deals before they found this one. But because it's a large group, they were able to do that in 4 months, 4 to 6 months, something like that. So especially when you look at a large market like Dallas, there's a lot of volume and inventory. So I believe there's another similar question, or at least on acquisitions coming up. Well, again, when reviewing construction rehab and the PM the PM management, how do you oversee that if your property is miles away from you? Well, I guess I've asset managed at least a lot of properties remotely, out of state. So you certainly want to go there every quarter at least, sometimes announced, sometimes unannounced. But otherwise, you have to take ask them to take pictures. You want to see that things are being done, and they have to show that it's being completed. And then I guess, and it's also like building a trust relationship, that you're going to re-inspect, for instance, at the beginning, a unit that would be inspected by the property manager, just to make sure it's in line with your expectation, and then let them do it. It's like at some point, it's like with any employee, it's like you have to treat them as your employees, and you have to trust but verify, like Reagan would say.
Yeah, you have to communicate expectations, establish what you need, what you require, and that's important, so that there's an understanding of what you're expecting. If you have, that you have distance. So, and then having that full trust that you're hiring a property management company that is going to be doing right by you. So that's part of the interview and due diligence process, ensuring that the property management company that you're working with is going to provide you what you need and what needs to get done.
All right, a lot of questions from Paula here and Esteban too. So we'll try to answer those as quickly as we can. How do you write into the company agreement what will happen if specific partners do not do their assigned duties? That's a very interesting question. Actually, initially on my first few deals, we didn't write anything, so it was very loose. And you know, I guess we are just holding each other accountable. One way to answer that question is to say, well, you know, if there is a party that is in control and responsible, kind of removes these questions. So you know, and I would say in that case, the responsible party, the one who has more than 50% of the GP, you know, they can just like decide to kick out whomever. You know, you're not doing your job. Sorry, you know, we're going to do it instead of you. What does that mean for the shares and so on? I would say at that point, if you want to you know, talk about that, certainly you need something written in the company agreement. And I would say talk to your lawyer about that. It's an interesting question. You know, I've seen change in the way things were organized, but which didn't result necessarily in change of ownership. So Esteban, which value add strategy have you seen work better? Rehab projects or turnkey with rent upside price discount? I've seen, you know, actually I've experienced both. You know, there's no, I've seen both work well and actually in some cases not work as well for various reasons. Usually I would say there's a little bit more meat on the bone on the rehab side than, you know, turnkey. But, you know, again, there's, you know, if you have more rehab work, there's more budget and more risks doing the renovations. So yeah, there's no clear winner here, unfortunately. Let's see if with interest rates going up tomorrow, perhaps another time, you gauge whether or not your tenants will leave. That's an interesting question too. I don't think the, you know, if you look the interest rates, you know, it's like there's some kind of trickle down from the Fed to, let's say, the treasuries, and then the treasuries to the interest rates that we experience. Talking about like the fixed rates, though more recently the effect wasn't as steep, and really the benchmark is going to be the treasuries. And I think there's going to be you know, the interest rate should not be the reason why you increase rents, because indeed, you know, if you increase rents for no reason because your debt is more expensive, you know, people they will, and you're above market, you know, it's not going to work. So that some tenants are going to try to find something cheaper, yes, but, you know, I think at the end of the day, you know, whatever space is going to be made available, let's say to the bottom, it will be filled from the top. So you know, the argument, especially, I guess, yeah, with COVID and so on at the time, there was an expectation of Class A properties to be more impacted at some point. You in case of a recession and so on, or sometimes there's an argument, let's say, to be made. Is class A that's going to be impacted, and sometimes it's an argument that on class C. So I see both sides. No clear winner again. Your criteria for finding experienced partners is understandable, but if you're new in the business, how do you get into the business if you have no experience? Well, you have to find a partner. That's it. You have to find an experienced partner to start. There's no way around that, in my opinion. How do you find foreclosure deals? Well, again, if you're a group that has a lot of volume and done a lot of acquisitions, the lenders, they will approach you because they know which deals are in trouble. And again, at this point, it's going to be the very prominent groups who have access to these opportunities. And I know for a fact, I know somebody who works in a family office, and they were invited by Arbor, the same lender who lent money for Apple's Way. They were invited in a private, meeting, seminar or whatever for a few days with select, high volume buyers talking about these opportunities. So, unfortunately for the time being, it's kind of reserved to very, very big players. Hopefully there will be more opportunities coming up for the rest of us. Yeah, so I don't see a question. Okay. Fed will increase rate tomorrow. How is it affect future rental rate increase timeline? I don't think it, the way what increase rental rates is inflation. When inflation was strong, the rents increased. And actually, rents, you probably know it's more than 30%, if not more, of the CPI. So, but if you look, if there is high inflation, rents will go up, but then expenses will go up. So everything is going up in parallel. So, which is kind of beyond the point there. Interest rates, they don't have an effect on rental rate, in my opinion. Right. Thank you. You're welcome, Paula. Neil Bauer was a webinar jury person. He said if interest rates go up any further, we'll not be able to increase our rents by 200 months as planned. Yes, will affect future rent increase.
Yeah, I mean, rents could only go up but so much. So there's a balance that the Fed, the government, needs to have, because a lot of this has to be taken into consideration. You have an election coming up, so there's a lot of politics involved, a lot of things to consider. But yeah, I mean, if rates keep going up, rents are not going to just continue indefinitely. So there's got to be a balance as far as price point goes. Prices can't keep going up, so prices need to come down in order to create that delta. So with analyzing all of the underwriting and interest rates and everything that goes into that, that's what brings the entire deal together. So if price is too high, it just doesn't make the deal work, and price is too high and the deal's not going to work. Don't expect only rents to be the motivating factor to make a deal work. The purchase price, you're making money on the buy. So think about that.
All right. See, thank you. It was, you're welcome. Yeah, I passed, I don't know if you can see the chat, I passed the note to Jeff, Paula. So I think I don't see any other questions. We're over the hour. Thank you so much for everybody to participate, ask many questions. We appreciate it.
And there's our email address on the screen. Feel free to reach out with anything, any questions, any concerns. If you want to learn more, feel free to email us. Check out our website, and yeah, we look forward to hearing from you.
All right. Thank you, and bye-bye.